Our financial system got flat out crazy in the years leading up to the 2008 meltdown. Democrats and Republicans are still battling about how to respond to it, and the Wall Street bankers who brought the whole thing on seem to think we're all just overreacting. I think part of the problem is that voters don't get just how bizarre things became. I'm going to try to explain that, and I'm going to start off using a metaphor.
Imagine a group of giant construction firms building houses across the country. Inspectors okay them, and people buy them, and of course they insure them too. But the inspectors suck, and a few people realize the houses are badly built, using crappy materials. Now these folks, they don't buy the houses. Instead, they take out insurance on them. Except since they don't own the properties, it's more like a bet that someone else's house will fall down. Well, then the builders realize the houses are made of crap, so they take out insurance policies, place bets, on the homes they're building. In fact, they build and sell crap homes on purpose, so now they can make money two ways. First, by selling the house to some poor dupe, and then by collecting the insurance, collecting on the bet, when the house falls down. Now for this to work, the inspectors and insurance companies have to be incompetent, but apparently that's not a problem. So then storms sweep the country, and the houses start falling down. And the insurance companies have to pay not just the homeowners, but also the people who bet against the homes. But the insurance companies weren't counting on so many of them falling down, so they run out of money and it can't make good. Well, homeowners lose everything. And then even the builders are in trouble because they've got an inventory of collapsed homes they can't sell now. A vicious economic cycle sets in. People have less money, so people buy less stuff. So the companies that make stuff lay off workers, which means people have less money, and the circle keeps going around. That's when the government steps in, and to stave off another Great Depression, it bails out the builders and the insurance companies. That's not a perfect analogy for the financial crisis, but it's close. Construction firms are like the investment banks from the financial crisis, places like Goldman Sachs and Deutsche Bank. And instead of selling houses made from crappy materials, they sell bonds made from subprime mortgages. Instead of homeowners buying crappy houses, you've got investors buying crappy mortgage bonds. Instead of building inspectors, you've got the bond rating agencies. The insurance company? It's an insurance company. And in both scenarios, sellers profit two ways, on the sale and on the collapse. That may sound impossibly bad, like a scam wrapped in dishonor inside a swindle, but it's still not enough to capture the madness. So let's dig deeper, starting with mortgage bonds. You might think that when you take out a mortgage, the bank lends you money and collects your payments, and it's just you and the bank. Really though, your lender bank sells these mortgages to an investment bank, like Goldman Sachs, who bundles those mortgages into what's called a mortgage bond. They earn fees by selling the bond to investors, who pay a big chunk of money up front and then get interest on a regular basis. This stream of interest depends on people making their mortgage payments, and if they default, the bond goes bad. So money flows from investors to investment banks to lender banks, who search for people to take out mortgages and buy homes. All this demand pushes up housing prices, so now the frenzy begins. We've got a housing bubble because everybody wants in on the action. And it doesn't even matter if you can afford a house, as long as you can hold on to it for a bit and sell it for a profit. Really though, we've started going crazy.
Suppose those lender banks had held on to their mortgages instead of selling them off to the investment banks. Well, then they would be depending on those mortgage payments for their income, so they would want to make sure you can actually pay them before they would give you a loan. But all that changes if they sell the loans off. See, they're not depending on mortgage payments anymore, so they don't care. They're depending on the sales fees they get from selling the mortgages to the investment banks. So they're going to want to make and sell as many mortgages as they possibly can, no matter how crappy they may be. And you're going to see mortgages start to go to people with bad credit ratings, no money down, no proof of income, just whatever the borrower promises they can pay. These mortgages were nicknamed liar loans. The official name for them is subprime.
Now at this point, the investment banks who bought those crappy mortgages have to deal with the risk. So when they bundle these loans into a mortgage bond, they make it with a lot of subprimes from a lot of people in a lot of regions, figuring if they're diverse enough, they won't all go bad, and the law of averages will give you a predictable rate of return, as long as the world keeps chugging along without surprises. Of course, you might be thinking, a diverse bundle of crap is still crap. Yeah, but we want to keep that bubble growing, so the investment banks come up with a solution. Mortgage bonds with different levels, called tranches, though I think of them as trenches. It's called a waterfall structure, and it works like this. People who buy in at the top trench, or the AAA trench, get first claim on the payments from the crappy mortgages. In exchange for this top priority, they earn a lower interest rate on their investment. And once all these AAA folks are paid off, money flows down to the next level, AA, which is riskier because what if so many homeowners defaulted that there is no more money? But in exchange for this higher risk, they also earn a higher interest rate. And it keeps going like this. Money flows down next to the single A investors, and so on, all the way down to the bottom trench, the unrated trench, which is very risky because it can go unfilled if even a small fraction of homeowners default. And by the way, AAA is a great bond rating. It's the lowest level of risk. A lot of investors, like pension funds, only invest in AAAs. And so here we see a bit more crazy. The finance people have magically turned risky mortgages into a low-risk asset. But it's about to get crazier. Those trenches on the bottom are so risky they're hard to sell. But remember, diversity is the financial answer to risk. Some hotshot decided, let's bundle a bunch of these unrated trenches together and create another waterfall asset from them. Seriously. They called it a collateralized debt obligation, or CDO. Remember that term. Just think of houses as the collateral and mortgages as the debt obligation. Just like before, the AAA folks get paid first, and the money cascades from there. And this is crazy. They made a AAA bond from the riskiest part of an asset built on risky mortgages. The only thing crazier would be if they did it again. They did it again. And made a CDO out of CDOs, specifically the worst trench of those CDOs. This CDO, made from CDOs, is called a CDO squared, and its top layer is rated AAA. Let that sink in. We started with a bunch of risky subprime mortgages, so bankers structured them into a waterfall mortgage bond. The top layer was low risk because it got first claim on the mortgage payments, and the bottom layer was high risk because it got whatever was left over, which might be nothing if enough homeowners defaulted on their mortgages. These bottom layers were hard to sell, so investment bankers bundled a diverse bunch of them into a new waterfall called a CDO, and called the top layer AAA, because it got first claim on the payments from the worst part of the lousy asset above it. Then they took the worst, riskiest layers of the CDOs and bundled them into another waterfall, the CDO squared, and called the top layer AAA, basically risk-free, even though it's really made from the riskiest part of an asset made from risky mortgages. By the way, when you hear newscasters talk about derivatives, this is the sort of thing they mean. Bonds derived from bonds, derived from bonds, derived from mortgages.
But why would the bond rating agencies like Moody's and Standard & Poor's go for that? Well, at this point, the mortgages have been bundled and sliced so many times that the rating agencies don't even really know what's in the bonds anymore. And frankly, neither do most of the bankers who are making them. And did I mention that the bond rating agencies are paid by the bankers? But it gets worse. There's a time bomb in the system, and it's called a 2-year teaser.
You've got investors pouring money into safe bonds built on crappy mortgages. But how do you keep creating new crappy mortgages? How do you keep getting more people to buy houses when they can't possibly afford them? By teasing them in with a low mortgage payment for 2 years, and then jacking it up when those 2 years are done. Some teasers let buyers pay so little that they didn't even cover the full interest charge. So after 2 years, the buyer ended up owing more on their house than when they started. But if the value of their house had gone up at the same time, they could still get out with a profit by selling the house, or maybe refinancing to get a new, even bigger loan. But even then, there's only so many new buyers out there to lure in. Housing prices started flattening in mid-2006, and then crashing. When those teasers expired, owners were stuck with payments they couldn't afford. They owed more than their houses were actually worth, and they defaulted. Those subprime payments started drying up, and a bunch of supposedly risk-free AAA assets started going bad. But it didn't stop there. Now we get to the core folly, the poison apple, the neutron bomb, credit default swaps. A credit default swap is like insurance on a bond. You pay premiums every year to an insurance company like AIG, and if those bonds go bad, AIG pays you what you insured the bond for. Some smart folks saw the 2-year time bomb and realized these bonds were going to go bad. So they bought credit default swaps, insurance policies, but they bought them on bonds they didn't even own. That's not insurance, that's more like placing a bet. And by mid-2007, the market in credit default swaps was $45 trillion big. One reason it got so big is that investment banks started insuring the bonds they had built. They'd sold a bunch of them, but they'd held on to others. And as homeowners started defaulting, banks wanted to cover their butts against the bonds failing. But it went way beyond that. Some banks started creating and selling bad bonds just so they could bet against them.
Goldman Sachs created a CDO, bet against it with a credit default swap, sold the CDO to its customers, and collected $1.7 billion when it went bust. Goldman also worked with a firm called Paulson & Company to build a bond just for Paulson to bet against. Paulson designed the bond, handpicking the crappiest mortgage assets, and Goldman sold it to its customers without ever telling them it had been specifically designed to fail. That's like somebody selling you a house without telling you it had been designed to collapse in a winter storm, allowing them to collect insurance on it, insurance on this house that they had built just so it would fall down, ruin you, and profit them. Goldman paid a $500 million fine for that. The Justice Department decided it didn't have the evidence or the laws in place to pursue criminal charges.
At this point, the financial system was like a house built out of balsa wood. When the storm hit, it hit hard. Not like rain, not like hail, more like asteroids slamming into the ground and sending shock waves in every direction. Bonds went bad, ruining the insurance company AIG, who couldn't pay off all the bets people had placed against them. Investment banks suffered huge, unsustainable losses when their inventory of bonds went bad and AIG couldn't pay. Who cares, you think? Well, the people who have savings there. Businesses that need investment capital to expand. Corporations who count on investment banks to manage their cash flow so they can pay their employees every other week. Working people who count on those paychecks. A vicious economic cycle sets in. That's when the government stepped in and bailed out the insurance companies and the investment banks. Now, you can hate that all you want, but a lot of economists all across the political spectrum were terrified at what might have happened without it. The problem now is that the strong banks bought the weaker banks to save them, so a lot of these banks that were too big to fail are now even bigger. And the bailout may have convinced banks it's safe for them to do this all again, a problem policymakers like to call moral hazard. Of course, homeowners weren't so lucky. No household out there is too big to fail. Homeowners defaulted, banks foreclosed, and from 2006 to 2011, American household real estate lost $6.5 trillion in value. That's equivalent to half of America's 2006 income. And you might say that wealth was never real, it was just on paper. But people borrowed against it, spent money, and planned their retirements as if it were real, which makes for one hell of a hangover. The housing bubble is kind of like drinking champagne all night and waking up to find you've blown 6 months' worth of pay out of your savings. And that doesn't even count what people lost in the stock market and their 401ks when that shockwave rippled out. Even people who didn't make bad choices are suffering now. No wonder consumers aren't spending like they used to and businesses aren't hiring faster. The economy sucks, but the miracle might be that it's still working at all.
And still you've got people like Jamie Dimon, CEO of JP Morgan Chase, telling Congress that when it comes to regulation, these are complex things that should be done the right way, in my opinion, in closed rooms. Talking about what works, what doesn't work, and collaborating with the business that has to conduct it. I hope you weren't expecting this video to end with a solution, because I don't have one. The immediate problem is the people who say that there is no problem, or that it's a minor problem, or one that Wall Street can fix on its own, or that government and Wall Street should fix together in closed rooms. Saying no to those people, to the bankers and politicians who are telling you that, is the first step to coming up with a real solution. And it's a step that every one of us can take. That's it. And for those of you who have stayed all the way to the end, thank you for your time.